In our last lecture, we learned about the language of financial reporting. Today, we'll learn about corporate analysis and valuation, which uses some of those concepts. Getting a handle on a corporation's value is an inexact science that depends on lots of assumptions. Think of what this task entails. We're taking a huge entity that may operate on 5 continents, controlling assets worth hundreds of billions of dollars, employing tens of thousands of people, competing with dozens of similar companies, and with new products under development, some barely on the drawing board. Yet we're trying to boil it down to a dollar value. How can we even begin to do that? We're going to find that if it's possible to value a company at all accurately, it's not easy. In fact, you'll probably decide that you don't need to do formal valuations. The reason we want to learn about valuation is that by understanding what drives corporate value, we'll understand why businesses make some of the decisions that they do, and we'll understand the limits of our knowledge. Many different valuation techniques exist, and it's rare that they'll agree on just how much a company is worth. That tells you that valuation is a horribly difficult problem and that there's no consensus on how to solve it. We have to deal with incomplete information, unverifiable assumptions, and even inconsistencies. Most analysts use one of 2 approaches to estimate the value of a company's stock. Some use a discounted cash flow approach. That approach has 3 steps. First, you try to forecast any of several values for the next few years. Common choices are dividends, earnings, and cash flow. Second, you estimate how much that stream of dividends, earnings, or cash flow is worth today. That's where the discounting in the name of this approach comes in. Third, you add your own secret sauce. Some analysts think growth is more important than the market's consensus, for example, and some focus on management quality. Show me 50 analysts and I'll show you 50 different secret sauces. A good analyst knows that in step 2, she's computed an estimate of the stock's value. It's a starting point for further analysis, and nothing more than that. The second main approach to valuing firms is the relative valuation technique. Analysts calculate a set of ratios that they think distills a company's value in the best, or at least the best workable, way possible. This approach also has 3 steps. First, you calculate the ratios. Common choices are the price to earnings ratio, the price to cash flow ratio, or the price to book value ratio. Second, you compare that ratio to those of competing firms in the same industry. For example, on July 11th, 2013, Lowe's was trading for about $43 or $44 per share. Its earnings over the last year were about $1.75. That works out to a price-earnings ratio of 24.92. Investors were paying almost $25 for each dollar of earnings that Lowe's produced. Home Depot's PE at the time was about the same, 25.30. You can see the appeal of this approach, can't you? 2 similar companies should have similar PE ratios, and if they don't, then you can make the case that one is overvalued relative to the other. The third step is once again adding the secret sauce, or the analyst's judgment. If you look more closely at the first valuation approach, the discounted cash flow valuation model, you'll see that dividends are the variable of interest. On July 11th, 2013, when Lowe's PE ratio was about 25, its annual dividend was $1.56. We need to estimate those dividends going forward. Go ahead, make your forecast. I'll wait. No, actually, I won't wait. Did you come up with an estimate, or did you freeze up for a second because you realized just how hard this is? And we're only on the first step. Let's take a guess at what those dividends will be.